All right, let's unpack this. Have
hmm
you ever stared at a tax form, especially one for your business, and felt a ripple of apprehension? Or maybe even a full-blown wave of intimidation? If so, you are absolutely not alone. Today, we're embarking on a deep dive into Form 941, the employer's quarterly federal tax return. It might sound, a little dry on the surface, but trust us, understanding this form is an essential compass for any employer navigating their payroll obligations.
Indeed. Yeah, Form 941 is frequently seen as, well, a complex puzzle, but mastering its intricacies is really foundational for sound financial management within your business.
Yeah.
Our goal today is to demystify it. We'll walk you through it line by line,
Okay.
focusing not just on compliance, but crucially on how to navigate it accurately and, yes, strategically to help manage your tax burden.
Right, strategy. I like that. Our mission today is to transform this critical document from a source of confusion into a clear, actionable roadmap. We'll guide you through each section, revealing what goes where, and maybe most excitingly, uncovering those aha moments. Those moments that can genuinely help you operate more efficiently and perhaps unlock some powerful tax-saving opportunities. Opportunities that are, explicitly laid out in the IRS's own instructions.
Precisely. We'll begin by establishing the fundamental purpose of the form,
Right.
clarifying exactly who is required to file it, and we'll highlight the significant updates that are taking effect for 2025. That's important.
Definitely need the latest info.
Then, we'll roll up our sleeves and delve into the specific lines that directly impact your quarterly federal tax return. We'll keep a keen eye on the mechanisms and credits designed to genuinely help you manage and potentially reduce your tax liabilities.
Okay, let's do it. Section 1, the foundation. So let's begin by laying that essential groundwork. What exactly is Form 941? And maybe more importantly, who needs to file it? Think of Form 941 as your employer's quarterly report card to the IRS. It's not an annual thing, it's a commitment you revisit every 3 months. As an employer, federal law requires you to withhold specific taxes from your employees' wages. This form is how you dutifully report those withholdings, along with your own designated share of certain taxes, directly to the IRS.
That's a great way to put it, a report card. When you pay wages, federal law mandates you withhold amounts for federal income tax, Social Security tax, and Medicare tax.
Yeah.
And additionally, if an employee's wages exceed $200,000 in a calendar year, you also have to withhold additional Medicare tax from the amount above that threshold.
Ah, that additional tax.
Yeah, and it's really important to distinguish here. The taxes you withhold from your employees pay the federal income tax, their share of Social Security, Medicare, additional Medicare tax. Those are ultimately credited to their individual income tax liabilities when they file their own annual returns.
Okay, so it's for their benefit eventually.
Exactly. But your business, as the employer, also has a separate distinct liability, your share of Social Security and Medicare taxes. This employer share is not withheld from your employees' paychecks. It's an additional tax your business is responsible for. Form 941 is the comprehensive report where you consolidate and report all these different components quarterly.
So if you're an employer paying wages subject to federal income tax withholding or Social Security and Medicare taxes, then you're definitely in the club. You must file Form 941. What exactly are we detailing on this form? It sounds like quite a bit.
It is pretty comprehensive. You're covering the total wages you've paid, any tips your employees have reported to you, the federal income tax you've withheld, both your share and your employee's share of Social Security and Medicare taxes.
Both shares.
Both shares. Any additional Medicare tax you've withheld, current quarter adjustments for things as precise as fractions of cents, sick pay, or even uncollected taxes on tips and group term life insurance. We'll definitely circle back to that.
Yeah, that sounds like one of those aha moments.
It can be. And yes, even the qualified small business payroll tax credit for increasing research activities. It's all on there.
Wow, okay.
It truly is a complete snapshot of your business's employment tax activity for that specific quarter. Now, it's equally important to understand who doesn't file Form 941
Yeah,
because there are specific situations and exceptions.
good point. Who gets a pass?
Well, for instance, if you're a very small employer, maybe your annual employment tax liability is $1,000 or less. The IRS might actually notify you to file Form 944 instead. That's an annual return, not quarterly.
Oh, annually. That would simplify things.
It can significantly simplify the reporting burden,
Yeah.
If you want to switch between 941 and 944, you need to request it. You'd call the IRS or send a written request, usually between January 1st and March 15th of the year you want the change to start.
Okay, good timing detail there. What about other unique scenarios, like seasonal businesses?
Certainly. Consider seasonal employers. If your business only operates, say, during the summer, and you don't pay wages in the fall or winter, You don't need to file Form 941 for those inactive quarters.
Makes sense.
But, and this is vital, you have to remember to check line 18 on every Form 941 you do file. That little checkbox tells the IRS, hey, don't expect a return from us next quarter, we're seasonal. Prevents unnecessary inquiries.
Smart. Just check the box.
Then you have employers of household employees, nannies, housekeepers. They typically report these taxes on Schedule H, filed with their personal Form 1040. For farm employees, you use Form 943. And it's important to remember, Form 941 is strictly for payroll taxes.
Only payroll.
Right. Not for backup withholding or income tax withholding on non-payroll stuff like pensions, annuities, gambling winnings. That's Form 945. And federal unemployment taxes, FUTA, that's Form 940.
Okay, different forms for different purposes. Keeping it straight is key.
Absolutely key to using the correct form for each tax obligation.
All right, that clarifies who files. Now, the tax landscape, it's always shifting, isn't it? And 2025 brings its own set of adjustments. Staying ahead of these changes is just as crucial as understanding the form itself. So what are the most significant updates we should have on our radar for 2025?
Yeah, there are a few important ones. One of the main updates for 2025 relates to the Social Security and Medicare tax rates and wage bases. The Social Security tax rate, that stays the same. 6.2% for both employee and employer, total of 12.4%. But the wage-based limit for Social Security, that's the maximum earnings subject to the tax, has been adjusted. It's $176,100 for 2025.
$176,100.
Okay, that's the cap for Social Security.
Correct. Now, for Medicare tax, the rate also stays put. 1.45% each for employee and employer, total 2.9%. And critically, there is still no wage-based limit for Medicare tax.
No limit. That's a big difference.
Huge difference. All wages, regardless of amount, are subject to Medicare tax. Additionally, the additional Medicare tax rate is still 0.9% for employees on wages over $200,000. And remember, there's no employer share for that specific tax. Only the employee pays it. Okay, so Social Security caps out, Medicare doesn't. Got it. Are there any updated thresholds for specific types of workers we should know about?
Yes, there are. For 2025, Social Security and Medicare taxes apply to household workers if you pay them $2,800 or more in cash wages during the year.
$2,800 for household workers.
And for election workers, these taxes kick in if they're paid $2,400 or more in cash or equivalent compensation.
$2,400 for election workers.
A significant procedural update, which should be a welcome change for many businesses, is that you can now file Form 941X electronically. That's the form for correcting a prior 941 or claiming a refund.
Oh, electronically. Finally.
Using the modernized e-file or Med-S system, it offers a streamlined, hopefully faster process for corrections.
That's good news. Definitely move towards digital efficiency. What about those COVID-related credits, the ones for sick and family leave? Are they still around?
Mostly gone. Those credits for qualified sick and family leave wages are largely expired for leave taken after October 1st, 2021. The lines used to claim these credits, they've actually been removed from Form 941 for tax periods starting after December 31st, 2023.
Okay, so the lines are just gone from the main form.
Right. It's just become extremely rare for employers to be paying wages now, in 2025, that relate way back to leave taken in 2020 or 2021. However, if, in a very rare situation, you are an employer paying qualified wages in 2025 for those earlier leave periods, you can still claim the credit.
Ah, okay, so how do you do that now?
You have to file Form 941X after you've filed your regular Form 941 for the current quarter. You can't file the 941X first. That can cause processing errors or big delays. So file 941, then file 941X for the credit.
Got it. File the main return first, then the correction form for the credit. Any other forms being retired or consolidated? Sounds like the IRS is cleaning house a bit.
Yes, definitely move towards consolidation. Forms 941SS and 941PR. Used by employers in U.S. territories like Guam, Puerto Rico. They were discontinued after the end of 2023. Employers there now just file the standard Form 941 or the Spanish version 941SP.
Simpler for them then.
Hopefully. And similarly, several key IRS publications, Pubs 51, 80, and 179, they've all been rolled into one comprehensive guide, Pub 15, the Employer's Tax Guide, and Pub 15 for Spanish.
One main guide instead of three. Makes sense.
Aims to centralize and simplify access to info. And speaking of Spanish, the IRS has made good progress there. Many forms now have readily available Spanish versions, like the 941SP and the W4SP.
That's great for accessibility. Really important. One last thing on these updates. I saw a mention of a payroll tax credit for tax-exempt orgs affected by disasters. Does that go on Form 941?
Good question, but no, it doesn't. While it is a payroll tax credit, that specific one is claimed on Form 5884D, not Form 941.
No.
Form 5884D. Yeah, it's a crucial distinction. Prevents filing errors, ensures the credit gets processed correctly. Again, it highlights why knowing which form is for what is so important.
All right, foundation laid, updates covered. Let's roll up our sleeves and get into the actual preparation of Form 941, part by part, line by line. There are some general rules here that might seem minor, but sound like they're absolutely vital for accurate processing. Avoiding headaches later, right?
They truly are vital.
Hmm.
The IRS really emphasizes clarity. They suggest typing or printing clearly, ideally using a 10-point Courier font if you're using tax software. The fillable PDFs from irs.gov usually handle the font okay.
Okay, clear printing or typing. What about formatting the numbers?
Ah, the numbers. This tricks people up a lot. Never enter dollar signs or decimal points. Cents should always be shown as 2 digits to the right of the pre-printed decimal point on the form.
No dollar signs, no decimals, just the numbers.
Exactly. So like $123 becomes $2,300 and $143.45 becomes $123.45. Also, leave fields with a zero value blank, except for lines 1, 2, and 12. Those need an entry, even if it's zero.
Lines 1, 2, and 12 always need something. Okay. What about negative numbers?
For negative amounts, use a minus sign, like negative 10.59. Or, if your software insists, you can use parentheses, 10.59. These little details, they're about speaking the IRS's language. Cuts down on processing errors, delays, saves you time and maybe money.
Precision and presentation is key. Got it. What about identification? That employer identification number, the EIN, that's got to be perfect.
Non-negotiable. Absolutely right. Consistency and accuracy are paramount here. Your business name and your EIN must be clearly shown on every single page of the Form 941, and any attached schedules or statements, too.
Every page.
Every page. Having an accurate, valid EIN is fundamentally required, especially for e-filing. An incorrect or missing EIN, that can lead to significant delays, unnecessary IRS notices, maybe even penalties.
Ouch. How do you get an EIN if you're just starting out?
Quickest way is online. irs.gov. You can also apply by fax or mail using Form SS4. If your EIN application is still pending when your Form 941 is due, file a paper return, write applied for and the date you applied in the EIN space.
Okay, applied for and the date. Good backup.
And it doesn't stop there. You need to tell the IRS immediately if your business name changes or your address or the responsible party associated with your EIN. Keep that info current.
Constant vigilance on the details. All right, let's move into the lines themselves, starting with line 1, number of employees.
Okay, line 1 asks for the number of employees who received wages, tips, or other compensation. Now, this isn't a total for the whole quarter. It's a specific snapshot.
How so?
You enter the number of employees for the specific pay period that includes March 12th for Q1, June 12th for Q2, September 12th for Q3, or December 12th for Q4. It gives the IRS a consistent reference point for your active workforce size.
Ah, the pay period, including the 12th of the last month of the quarter.
Exactly. And when you're counting, remember to exclude certain categories. Household employees, anyone in non-pay status for that specific period, farm employees, pensioners, active military, they have different rules. It's basically a count of your core active employees for that one specific payroll cycle.
Okay, very specific snapshot. Then line 2, wages, tips, and other compensation. What exactly goes in here?
Line 2 is meant to capture the total compensation you paid during the quarter that would eventually show up in Box 1 of your employee's W-2 forms. It's your total taxable compensation paid to everyone for the quarter.
So pretty much everything you paid out.
Generally, yes. It also includes sick pay if it was paid by your agent, or by a third party like an insurance company if they gave you timely notice and explicitly transfer the liability for the employer's taxes to you. If you are the third-party payer, you wouldn't include it here if you notified the policyholders properly. So in essence, it's all the compensation you paid that's generally subject to federal income tax.
Okay. Line 3 is federal income tax withheld. That seems fairly straightforward.
Yes, line 3 is exactly that. The total federal income tax you withheld, or were required to withhold, from all wages, tips, taxable fringe benefits, supplemental unemployment benefits paid during the quarter. It also includes any excise taxes on those golden parachute payments, those big severance packages sometimes.
Got it. Total income tax held back. And what about line 4? It says, if no wages, tips, and other compensation are subject to Social Security or Medicare tax. When would that happen?
You check this box on line 4 only if, for some very specific reason, none of the wages, tips, or other compensation you reported on line 2 are actually subject to Social Security or Medicare tax. This is pretty rare for most businesses. Maybe certain types of exempt wages. Important note, if you're a government employer, your employees' wages aren't automatically exempt. They might be covered by law or a specific agreement. For the vast majority of employers, this line stays blank. Almost all wages are subject to these taxes.
Okay, blank for most people. Now we're getting into the real engine room, right?
Yeah.
Lines 5A through 5E, taxable Social Security and Medicare wages and tips, the core calculations.
Indeed. This is where the numbers really start to build. Line 5A is for taxable Social Security wages. This is the total wages, sick pay, taxable fringe benefits subject to Social Security tax that you paid during the quarter. Crucially, enter this amount before any payroll deductions, and don't include tips here. Tips go on line 5B.
Wages only on 5A before deductions. Got it.
For 2025, the rate is 6.2% each for employer and employee, so you multiply the wages by the combined 0.124 rate. And here's a critical detail, really key for managing liability: the wage base limit. You stop paying Social Security tax and stop entering an employee's wages on line 5A once the combined taxable wages and tips hit that $176,100 limit for the year.
Stop at $176,100 for Social Security, but keep withholding other taxes.
Absolutely. You must continue withholding federal income tax and Medicare tax for the entire year, even after the SS wage base is reached.
Okay, that $176,100 limit is absolutely key for Social Security. What about tips? Line 5B is taxable Social Security tips.
For line 5B, you enter all tips your employees reported to you during the quarter. Just like wages, these tips are also subject to that $176,100 wage base limit when combined with the wages on line 5A for that employee. Now, you must include all tips your employee reported, even if you couldn't actually withhold the employee's 6.2% Social Security tax from their pay.
Even if you couldn't collect it, how does that work?
This is where we'll get to that important tax-saving mechanism later on line 9. You'll actually be able to adjust and reduce your total taxes by the amount of any uncollected employee share of Social Security and Medicare taxes on tips.
Ah, okay. So you report it here, but adjust later if you couldn't collect. That's valuable.
Exactly. It acknowledges the practical reality. The calculation for 5B is the tip amount times the combined 0.124 rate.
What are the rules for employees reporting tips to you?
Employees need to report cash tips, including credit card tips, debit card tips, tip sharing to you by the 10th day of the month after they get them. They don't need to report if their tips for a month are less than $20. And don't confuse these with allocated tips. Those are different, reported on Form 8027, not usually on the 941.
Good distinction. Less than $20. No report needed. Okay. Moving on to Medicare, line 5C. Taxable Medicare wages and tips. Is there a wage limit here too?
No, and this is the crucial difference. For Medicare tax, there is no wage base limit. None at all. You enter all wages, tips, sick pay, taxable fringe benefits subject to Medicare tax for the quarter on line 5C. The rate is 1.45% each for employer and employee, total 2.9%. And just like with Social Security tips, you include all reported tips, even if you couldn't withhold the employee's share. The calculation is column 1 times 0.029.
No limit on Medicare. Every dollar is taxed. Got it. Now, line 5B, taxable wages and tips subject to additional Medicare tax withholding. This one feels a bit different.
It definitely is. This tax applies only to the employee's share. Rate is 0.9%. No employer share here. You start withholding this additional Medicare tax in the pay period when an employee's wages for the year go over $200,000.
$200,000 threshold for that one.
Right. Once they hit that, you keep withholding it for the rest of the year. All wages subject to Medicare are also subject to this additional Medicare tax withholding if they're paid above that $200,000 threshold. So once an employee crosses that mark, you calculate the amount in column 1 of line 5B by multiplying it by 0.009.
Okay, employee only, over $200K. So 5A through 5B are the individual pieces. Line 5B pulls it all together.
Exactly. Line 5E is the total Social Security and Medicare taxes. It's simply the sum of the calculated tax amounts in column 2 from lines 5A, 5B, 5C, and 5 pence. This gives you your total Social Security and Medicare tax liability for the quarter before any adjustments.
Okay, the subtotal for SS and Medicare. And what about line 5, section 3121Q, notice and demand tax due on unreported tips? That sounds very specific.
It is very specific. Most employers will probably leave this blank. You only use this line if the IRS sends you a section 3121Q, notice and demand. This happens when the IRS figures out employees got tips they didn't report to you or underreported them. The key thing is, you, the employer, are not liable for your share of SS and Medicare taxes on these unreported tips until the IRS sends this formal notice.
Ah, so the liability only starts when you get the notice.
Correct. Once you get that notice, then you have to deposit that tax according to your schedule. The tax is treated as accumulating on the date printed on the notice, so it's a direct IRS notification that changes your liability for past periods based on their findings.
Okay, a very specific situation triggered by the IRS. Then line 6 is the grand total before we get into adjustments.
Correct. Line 6, total taxes before adjustments is a straightforward sum of. Line 3, income tax withheld. Line 5E, total SS and Medicare taxes. And line 5F, any tax from that 321Q notice. This gives you your initial total tax liability for the quarter, the starting point before we fine-tune it.
Okay, now this next section, this is where it gets really interesting for managing your actual tax liability. This is where those tax-saving opportunities we talked about truly start to emerge. Lines 7 through 9, current quarter's adjustments.
Exactly. These adjustments modify that initial liability figure from line 6. Critically important. When you enter these, use a minus sign or parentheses to clearly show an adjustment that decreases your total taxes, like negative 10.59 or 10.59.
Got to show it's a reduction.
Yes. And these adjustments are specifically for items impacting your Social Security and Medicare taxes within the current filing quarter.
Okay, so line 7 is adjustment for fractions of cents. That sounds tiny.
It is usually small, yeah. But it shows the level of precision needed. Because of rounding, when calculating the employee share of SS and Medicare, the amounts actually withheld might be off by a few cents from the exact statutory rates. Line 7 accounts for these tiny differences. It can be positive or negative, just ensures your reported tax matches the precise calculation.
Okay, fine-tuning the pennies. Then line 8, adjustment for sick pay. How does that work as an adjustment?
This mostly comes up when you have a third party paying sick pay, like an insurance company, who is not your agent. If that third party transfers the liability for the employer's share of SS and Medicare taxes to you, then you enter a negative adjustment on line 8.
A negative adjustment, why?
Because that negative adjustment represents the employee's share of SS and Medicare that the third party already withheld and deposited. You're basically backing it out so you don't pay it twice. Conversely, if you are the third-party payer and you transfer the employer's share liability to the employer, you'd also enter a negative adjustment for that employer's share the employer now has to pay. No adjustment needed if sick pay goes through your agent, though. That's treated as if you paid it directly.
Okay, complex interactions with third-party payers. Now, for what I think is a really powerful tax-saving adjustment, maybe one people overlook, line 9, adjustments for tips and group term life insurance. Here's where it gets really interesting for managing liability. If you couldn't collect certain taxes from employees, the IRS gives you a path right here.
Exactly. This is a direct reduction in your reported tax liability. Super important for businesses with tipped employees. You enter a negative adjustment on line 9 for any uncollected employee share of Social Security and Medicare taxes on tips.
So how does that work practically?
Well, let's say by the 10th of the month after you got an employee's tip report, you genuinely don't have enough of their funds available, maybe low wages at pay period, to withhold those taxes from their pay. If that happens, you're no longer required to collect those specific taxes from that employee. You still report the full amount of tips back on lines 5B and 5C, but then you make this crucial negative adjustment here on line 9.
So you report the income, but adjust out the tax you couldn't collect.
Precisely. It ensures you aren't paying tax you couldn't reasonably get. You do the same thing for any uncollected employee share of SS and Medicare on group term life insurance premiums paid for former employees. It might seem small, but accurately accounting for these on line 9 directly reduces your total reported tax, helps your cash flow. It's about paying only what's truly due.
That's fantastic. A real practical adjustment. Every bit counts for cash flow. Okay, after those adjustments, we get line 10, total taxes after adjustments. That's just the sum of lines 6 through 9. But then we hit what sounds like one of the biggest tax-saving opportunities on the whole form. Line 11, qualified small business payroll tax credit for increasing research activities.
This is, without a doubt, a powerful incentive, designed specifically to foster innovation in small businesses. And big news here, the Inflation Reduction Act of 2022 actually increased the maximum amount of this credit you can use against payroll taxes. It went up to $500,000 annually, starting for tax years after Disco in 2022. It used to be $250,000.
Doubled it. Wow, $500,000 against payroll taxes.
Annually, yes. It's explicitly designed to encourage qualified small businesses to invest in R&D activities, new or improved products, processes, software.
So how does a business actually claim this? It sounds amazing, but probably not automatic. Sounds like there's a strategic element here.
You're absolutely right. It's not automatic, and it requires proactive planning. It's a multi-step process. First, you make the election to claim this credit on Form 6765, Credit for Increasing Research Activities. You file that with your business's income tax return.
Okay, Form 6765 with the income tax return, step 1.
Step 1. Then, the specific amount of the credit you plan to use against payroll taxes. That gets reported on Form 8974, qualified small business payroll tax credit for increasing research activities. Now, here's a critical point for timing and strategy.
Okay.
The credit you can use against payroll taxes is applied in the first calendar quarter beginning after the date you actually filed the income tax return where you made that election.
So it's delayed, you do the R&D, file your income tax return making the election, and then you start using the credit against payroll taxes in the next quarter.
Exactly. Which means diligent record keeping of your innovative activities throughout the year is absolutely key. It directly translates into tax savings later.
Mm.
Many small businesses miss out because they don't adequately track R&D expenses, even for small projects. You need systems to capture those eligible costs.
Track everything R&D related. Okay, so it's delayed, but the payoff can be huge. And this is where the direct tax saving really happens, reducing your actual payroll tax payments.
Precisely. This is the mechanism. Starting in 2023, this payroll tax credit is first used to reduce the employer's share of Social Security tax. You could apply up to $250,000 of the credit per quarter against that employer SS tax liability.
$250 per quarter against the employer's Social Security share. Okay. What if the credit is more than that?
Good question. If, after reducing the employer's share of Social Security tax, you still have credit left over, it then goes towards reducing the employer's share of Medicare tax for that same quarter.
Okay, first SS employer share, then Medicare employer share.
Right. And if there's still credit left after reducing both of those employer shares for the quarter, it gets carried forward to the next quarter.
Carry forward, that's huge.
It is. It's a direct tax-saving mechanism. By applying this credit against your business's portion of SS and Medicare, you effectively lower your actual quarterly cash outlay. Frees up capital for investment, operations, growth. But remember the limitation. It cannot be used against income tax withholding or the employee share of SS or Medicare, and it can't be carried back. Employer share only and forward carry only.
Crucial limitations. Employer share only, carry forward. Okay, so what does this really mean for a business? Let's use that Roseco example from the source. Really picture it. Reducing actual payroll tax bills directly.
Okay, let's look at Roseco calendar tax year. They timely filed their 2024 income tax return on April 15, 2025. On that return, they successfully elected to take this qualified small business payroll tax credit. Now, the third quarter of 2025, starting July 1st, is the first quarter they can actually apply the credit against payroll taxes because it begins after they file that income tax return.
Okay, Q3 is when it starts for them.
Right. Roseco happens to be a semi-weekly scheduled depositor, meaning they track liability daily. When they fill out their Schedule B for Q3, they'll reduce the liability reported for their very first payroll payment in Q3. That includes Social Security wages. The reduction is for the lesser of A, their employer's share of Social Security tax up to that $250 quarterly limit, or B, the amount of payroll tax credit they have available.
And if the credit is more than their employer SS share for just that one payroll, does the rest get wasted?
No, absolutely not. That's the beauty of the carry forward within the quarter, too. If the credit is more than their employer's SS share for that first payment, the excess carries forward to the next payroll payment within Q3. It keeps applying against the employer SS share on subsequent payrolls until they either use up the credit or hit that $250,000 quarterly max against Social Security.
Okay, it keeps rolling within the quarter against SS first. What if they max out the SS part and still have credit left?
Then, any remaining credit gets applied against their employer's share of Medicare tax. Again, starting with the first payroll payment in Q3, that includes Medicare wages. And if, after all that reducing employer SS and employer Medicare for Q3, they still have credit left over,
Then it carries forward to Q4.
exactly, it's carried forward and treated as available credit for the fourth quarter. And if they still have credit after Q4, it can carry forward into 2026 and so on until it's fully used. This is a direct tax-saving lifeline. It tangibly lowers the quarterly cash outlay, freeing up precious capital. The carry forward ensures the full benefit is eventually realized.
That example really clarifies how significant and, well, strategic this credit can be. Amazing. Finally, line 12, total taxes after adjustments and non-refundable credits. This is the bottom line for the calculation part.
Yes, line 12 is your final calculated tax liability for the quarter. You just subtract line 11, your R&D credit used this quarter, from line 10, your total taxes after other adjustments. The result on line 12 cannot be less than 0. This is the number that determines if you owe money or if you've overpaid for the quarter. Sets the stage for the next steps.
That's a huge step, getting that final liability number. But the journey isn't quite over. Now that you know your total tax on line 12, the next critical phase is making timely payments and deposits. And maybe most importantly, strategizing to avoid those unwelcome penalties. Let's start with line 13, total deposits for this quarter.
Right. Line 13 is where you tally up everything you've already sent to the IRS for the quarter. It includes all the federal tax deposits you actually made during the quarter, plus any overpayment from a prior quarter that you specifically chose to apply to this return, or any overpayment that came from filing a Form 941X during this current quarter. Think of it as your running total of payments already made against this quarter's liability.
Okay, so what you owe, line 12, minus what you've paid, line 13, that leads to either a balance due or an overpayment. Line 14 is for the balance due.
Correct. If line 12, total taxes, is more than line 13, total deposits, you have a balance due. You enter that difference on line 14. Small note, if it's under $1, you don't actually have to pay it.
Under a dollar, forget about it.
Now, generally, you should only really have a balance due on line 14 if your total taxes for the quarter, or maybe even prior quarter, were pretty small, less than $2,500.
Yeah.
And you didn't trigger that $100,000 next day deposit rule we'll talk about. But here's a critical point. If your business was required to make federal tax deposits based on your schedule,
Yeah.
but you decide to just pay the amount with Form 941 instead of making timely deposits throughout the quarter, you will likely face penalties, even if you pay the full amount with a form by the deadline. The IRS cares when you pay, not just how much. Timeliness of deposits is key.
Ooh, that's a really important warning. Don't just wait and pay with the form if you were supposed to deposit earlier. What if a business is genuinely struggling and can't pay the full balance on line 14? Are there options?
Yes, there are options, although paying in full is always best if possible. If you truly can't pay the full amount, your business might be eligible for an installment agreement online. You can apply through irs.go OPA if the total amount owed is $25,000 or less, and you can commit to paying it off within 24 months.
Okay, 25K limit, 24 months, an online application.
Right. But crucially, remember, interest and penalties keep accruing on the unpaid balance until it's fully settled. And to keep the agreement active, you must make all future required deposits and file all future returns on time during the entire agreement period. Slip up, and the agreement can be terminated.
High stakes to stay compliant once you're in an agreement. Okay, what if you did too well with deposits? Line 15, overpayment.
That's the better scenario. If line 13 deposits is more than line 12, total taxes, you have an overpayment. Enter that difference on line 15. Then you have a choice. Check the box to get a refund, or check the box to apply to your next return. You have to pick one.
What if you forget to check a box?
Default is applying to the next return, so if you want a refund, make sure you check that box. Also, be aware, the IRS can always apply any overpayment to past due tax accounts you might have first before refunding or applying forward. And if the overpayment is less than $1, they'll only refund or apply it if you specifically ask them to in writing.
Okay, make your choice clear. So getting those deposits right and on time is critical. And speaking of deposits, the IRS is really pushing electronic funds transfer, EFT, right? It's basically mandatory.
It's an absolute mandate now. All federal tax deposits, income tax withholding, SS, Medicare, FETA, must be made by EFT. The most common and free ways are the Electronic Federal Tax Payment System, EFTPS, or IRS Direct Pay, or through your IRS business tax account online.
EFTPS, Direct Pay, IRS online account. Free options.
Correct. You can also have a tax pro, a bank, or a payroll service do it for you, but they might charge a fee. The electronic mandate is about efficiency, security, accuracy for the IRS, and timing is key. Generally, for EFTPS, you need to submit the payment by 8 p.m. Eastern Time the day before the deposit is due.
8 p.m. Eastern the day before. Gives the system time. What if you miss that deadline? Like an emergency happens. Is there a last resort?
There is, but it's really a last resort due to potential complexity and cost. It's the Federal Tax Collection Service, FTCS, allows same-day wire payments. If you miss the EFTPS deadline, you might still get it in on time this way, but you need prior arrangements with your bank and they'll likely charge you a fee. Not for regular use.
Okay, same-day wire as a backup, but plan A is EFTPS the day before.
Definitely. Also, practical point, if a deposit due date falls on a weekend or a legal holiday, the deposit is timely if it's made by the close of the next business day.
Good to know about weekends and holidays. So planning ahead for deposits is crucial. How does a business even figure out its deposit schedule, monthly versus semi-weekly? Seems important for knowing when to pay.
It is very important. It's determined by your look-back period. That period runs from July 1st of the second preceding calendar year through June 30th of the preceding calendar year.
Yeah.
So for determining your 2025 schedule, you look back at July 1st, 2023 through June 30, 2024.
Okay, look back is mid-year to mid-year, spanning the 2 prior years. Then what?
You look at your total Form 941 tax liability reported during that look-back period. If your total tax was $50,000 or less during that period, you're generally a monthly scheduled depositor. Deposit once a month. If your total tax was more than $50,000 in the look-back period, you're typically a semi-weekly scheduled depositor, more frequent deposits.
$50,000 is the magic number in the look-back period. Below is monthly, above is semi-weekly.
Generally, yes, but there's a big exception that can change things fast.
Ah, that $100,000 next day deposit rule. That sounds like something employers need to watch out for.
Absolutely. This is critical. It can catch businesses off guard, especially if they have fluctuating payroll or rapid growth. Here's how it works. If you accumulate a tax liability of $100,000 or more on any single day during a deposit period, monthly or semi-weekly, you must deposit that tax by the close of the next business day.
A $100 K triggers a next day deposit requirement.
Wow. And it gets more significant. If you trigger this rule, you automatically become a semi-weekly scheduled depositor for the rest of that calendar year and the entire following calendar year, even if you're a monthly before. And that $100,000 threshold, it's calculated before you consider any reduction from non-refundable credits, like that R&D credit.
For credits. Okay, so a big payroll could flip your schedule immediately.
Exactly. Imagine a usually monthly depositor having a huge one-time bonus payroll, hits 100K, boom, next day deposit for that amount, and semi-weekly deposits required from then on. Failing to adapt quickly leads to immediate, potentially large penalties. Constant monitoring of your accumulating liability is essential.
That rule demands vigilance. Okay, let's talk part 2 of the form, line 16, reporting your tax liability.
Line 16 is where you show the IRS how your total liability from line 12 accumulated over the quarter, matching your deposit schedule. First, there's a de minimis exception. If your total tax on line 12 is less than $2,500
Less than $2,500.
for the current quarter, or it was less than $2,500 in the prior quarter, and you didn't trigger that $100K next day rule, you can check the first box. In this case, you generally don't need to make separate deposits. Just pay the amount due with the return when you file it. Simplifies things for very small liabilities.
Okay, under $2,500 exception, pay with return. But if you're a monthly depositor,
If you're a monthly scheduled depositor, check the second box on line 16. Then you must enter your tax liability for each month of the quarter. Month 1, month 2, month 3. This is crucial. You enter your liability for the months, not the deposits you made.
liability, not deposits. Got it.
Right. So for Q1, liability for Jan, Feb, March. And the sum of these 3 monthly liabilities must exactly equal your total tax on line 12. If they don't match, your deposits might not be counted as timely. Penalties can follow. It's about matching reported liability to accrued liability month by month.
Precise matching is key. And for semi-weekly depositors, they use Schedule B, right?
That's right. If you're semi-weekly, check the third box on line 16. Instead of the monthly breakdown on Form 941, you must complete and submit Schedule B, Form 941. Schedule B requires you to detail your tax liability for each day of the entire quarter.
Daily liability on Schedule B. Wow, that's detailed. What if you don't submit it?
Penalties. If you're required to file Schedule B and don't, the IRS might assess deposit penalties based on an average liability calculation. And that average calculation is almost always less favorable than if you had accurately reported your daily liability. So, file Schedule B if you're semi-weekly.
Don't skip Schedule B. Okay, this sounds complicated, especially factoring in that qualified small business payroll tax credit from line 11. How do you account for that credit when you're reporting your daily or monthly liability on line 16 or Schedule B? You need to avoid mismatches, right?
Excellent question. This is exactly where strategy meets compliance for that big tax-saving credit. Both monthly and semi-weekly depositors must account for the line 11 credit when reporting their liabilities on line 16 or Schedule B. The total liability you report here, daily or monthly, must equal the final tax amount on line 12.
So how do you make it match when the credit reduces the total?
You incorporate the credit by reducing the liability figures you enter on line 16 or Schedule B. Remember how the credit applies. First, against the employer's share of Social Security tax. So you start reducing your reported liability for the employer's share of SS tax, beginning with the first payroll payment of the quarter where the credit applies. Once that's used up, or you hit the $250 quarterly limit, any remaining credit then reduces your reported liability for the employer's share of Medicare tax, again starting with the first relevant payroll payment. You reflect these reductions directly in your daily Schedule B or monthly, line 16, liability tracking.
Ah, so you reduce the liability before you even write it down on Schedule B or line 16.
Exactly. That way, the sum of your reported daily or monthly liabilities will match the final calculated tax on line 12, which already reflects the credit. This avoids mismatches that trigger penalties. Any credit left at the end of the quarter just carries forward. It's meticulous, but ensures you get the full tax-saving benefit and your records align perfectly.
Wow. Okay, meticulous accounting is needed there. So, what does this all really boil down to for a business owner? The IRS clearly wants you to get this right, and the consequences sound serious if you don't. Maybe more than just financial.
This brings up a profoundly important point. Why is accuracy and timely payments so absolutely critical, especially for these employment taxes? The core reason is they are trust fund
It's
taxes.
just fun taxes.
Yes, the federal income tax and the employee's share of Social Security and Medicare taxes. These are funds collected from your employees' paychecks. Legally, you, the employer, hold these funds in trust for the U.S. Treasury before you remit them. Failing to collect, account for, and pay over these trust fund taxes isn't just a missed payment. It's seen as a breach of that trust, and that can lead to severe personal liability for the people responsible.
Personal liability
Yeah.
for business taxes.
Yes, specifically for these trust fund taxes. You can generally avoid penalties and interest by doing things right. Deposit pay on time, file complete accurate 941s on time, report liability accurately, use valid checks, furnish accurate W-2s on time, file W-3s on time. But if those trust fund taxes, the ones that must be withheld, are not withheld, or not deposited or paid over, the trust fund recovery penalty can apply.
Trust fund recovery penalty. That sounds serious.
It is. The penalty is 100% of the unpaid trust fund tax. 100%. And if the IRS can't immediately collect these unpaid taxes from the business entity itself, this penalty can be imposed on all persons the IRS determines were responsible for collecting, accounting for, or paying over these taxes, and who acted willfully in not doing so. This can include owners, officers, directors, bookkeepers, other employees, anyone with the authority and responsibility who willfully failed to pay. It pierces the corporate veil, essentially. Very serious personal risk.
Okay, that trust fund recovery penalty is a huge motivator to get this right. Beyond the numbers and penalties, Form 941 also asks some important questions about your business operations in Part 3. Tell us about your business. Seems straightforward, only answer if they apply.
That's right. You only fill these out if they describe something that happened during the quarter. For example, line 17 is if your business is closed. Oh. If you permanently shut down or just stop paying wages altogether, you must file a final Form 941. Check the box on line 17, enter the final date you paid wages, and critically, attach a separate statement. It needs to show the name and address of whoever will keep your payroll records, just in case the IRS needs them later.
Okay, final return, check box, provide record keeper info. What if your business is seasonal, like that summer camp example? Line 18 is for seasonal employer.
If you operate seasonally, only hiring and paying wages during certain times of the year, you must check the box on line 18 on every Form 941 you file, even for the active quarters.
Check it every time you file.
Every time. This tells the IRS, don't expect returns from us during our off-season. If you forget to check this box consistently, the IRS system will expect a return every quarter. They might start sending you notices about unfiled returns for your inactive periods. Unnecessary hassle.
Just check the box. Easy way to avoid confusion. What happens if a business goes through a major change, like a sale or reorganization? That must affect Form 941 filings.
It absolutely does. Common source of confusion here. If you sell or transfer your business mid-quarter, both the old owner and the new owner must file a Form 941 for that specific quarter. Each one reports only the wages they paid during their period of ownership within that quarter.
Both file reporting only their own wages. Makes sense.
Also, if you change your business's legal structure, say, sole prop becomes a corporation, or partnership becomes an LLC taxed as a corp that's considered a transfer for tax purposes.
Yeah.
And it very often means you need to get a new employer identification number, a new EIN.
A new IN might be needed for structure changes.
Okay. Yes. In these transfer situations, you should attach a statement to your return. Include the new owner's name, the new business type, details of the change, the date, and where the payroll records will be kept. For more complex stuff like formal statutory mergers or consolidations, you might even need to file Schedule D, Form 941, to detail that reorganization.
Okay, specific procedures for big changes. What if you just made a mistake on a past 941? How do you fix it?
You use Form 941X. It's the Adjusted Employer's Quarterly Federal Tax Return or Claim for Refund. You file it separately from your regular 941, and as we mentioned, the great news is you can now file Form 941X electronically via MEF. Should be much easier and faster.
E-filing for corrections is a big plus. Now, many businesses outsource payroll, right? Using PEOs, professional employer organizations, or other third-party payers. What should employers know about that?
Vital area to understand clearly. The IRS has a voluntary certification program for PEOs, making them CPEOs. These CPEOs are generally treated as the employer for employment tax purposes, handling payroll admin and tax reporting.
Uh,
However, and this is crucial even if you outsource payroll, you, the employer, generally remain ultimately responsible.
Ultimately responsible, even with a PEO.
Generally, yes, for ensuring returns are filed correctly and deposit payments are made on time. If the third party fails, you could still be held liable. Especially with non-certified PEOs or basic reporting agents, you need crystal clear understanding of responsibilities. Ask questions. How do they ensure timely deposits? Whose EN are wages reported under? How are errors corrected? What liability do they assume? Do thorough due diligence.
Due diligence is key when outsourcing.
And if, say, an employee worked for you part of the quarter, then move to a client company using a PEO. Both you and the PEO might need to file a 941 reporting the wages each paid, and both issue W-2s. Large aggregate filers like CPEOs often use Schedule R, Form 941, along with the main 941.
Lots of complexity when third parties are involved. Now, thinking about other credits, another opportunity for specific organizations to reduce their tax burden while doing good. The Work Opportunity Tax Credit for qualified tax-exempt organizations hiring veterans.
Right. What's fascinating here is seeing tax code weave social policy with economic incentives. Qualified tax-exempt orgs hiring eligible unemployed veterans can potentially claim the Work Opportunity Tax Credit. It's a direct payroll tax credit, reducing their liability. But remember, this specific credit is claimed on Form 5884C, not on Form 941.
Form 5884C for the Veteran Hiring Credit.
Got it.
Yeah. It offers a clear payroll tax advantage for eligible nonprofits, supports veteran employment, provides a financial benefit, win-win if eligible.
Great example. Okay, let's touch on part 4 quickly. May we speak with your third-party designee? What's this about? This section is actually pretty useful. It lets you authorize the IRS to talk directly to someone else about this specific Form 941. Could be an employee, your paid tax preparer, anyone you designate. You check yes, provide their name, phone number, and a 5-digit PN you make up for them.
So you give permission for the IRS to talk to your accountant, maybe?
Exactly. It authorizes the IRS to call your designee if they have questions while processing this return. They can ask for missing info, discuss math errors, but understand the limits. The designee cannot bind you to anything, can't receive your refund, can't fully represent you on other matters, and the authorization automatically expires 1 year from the Form 941 due date. It's just for convenience regarding this specific form.
Limited scope, limited time. Good convenience feature, though. Finally, part 5. Sign here. Absolutely essential. Who can actually sign this thing?
Depends on your business structure. Sole proprietorship, the individual owner, corporation, or LLC taxed as one, president, VP, or another authorized principal officer, partnership, or LLC taxed as one, a responsible, authorized partner, member, or officer who knows the business, trust or estate, the fiduciary, like the trustee or executor. A duly authorized agent can also sign if there's a valid power of attorney on file with the IRS.
Okay, specific roles for specific entities. What about paid preparers?
If you pay someone to prepare your Form 941 and they aren't your employee, they have to complete and sign the Paid Preparer Use Only section in Part 5. They need to include their preparer tax identification number, PTIN, their address, their firm's EIN if they have one, and they are legally required to give you, the client, a complete copy of the return. Remember, their PTIN identifies them personally. It doesn't replace the firm's EIN.
Okay, preparers have their own section and requirements. This has been incredibly detailed. A real deep dive into Form 941 covered everything from definitions to strategies to compliance pitfalls. For listeners wanting more info or help, where should they turn?
The IRS offers a lot of resources, many free. You can call their helplines for specific 941 questions or deposit rules guidance. IRS.gov Forms is the main hub for forms, instructions, publications. You can order paper forms at irs.gov or forms. Electronic filing info is at irs.gov employment e-file. Payment options and EFTPS enrollment are at irs.gov payments and eftps.gov.
Lots of online
Resource.
Definitely. And the IRS actually encourages feedback. If you have ideas to simplify Form 941, you can submit them via irs.gov form comments, #tag outro.
Wow. We have truly journeyed through the intricate landscape of Form 941 today. We've uncovered not just what goes in each box, but really why it matters. And crucially, where those smart adjustments and powerful credits actually live within its pages. Understanding these things, from adjusting for uncollected tips to leveraging that R&D credit, can genuinely impact your business's bottom line. Indeed. I think the fundamental takeaway here is that proactive, informed engagement with these forms, moving beyond just compliance, really empowers you as an employer. It lets you actively manage tax liabilities and strategically use the available incentives. It's about informed decisions that free up capital, optimize finances.
Turning a burden into maybe a strategic advantage.
So as you look at your next Form 941, maybe consider this.
Yeah.
Beyond just the numbers and the check boxes, highlight a deeper understanding of these seemingly small but actually profound details like the nuances of that research credit
Yeah.
or the critical timing of your deposits. How might that transform your whole approach to business growth and financial planning? Where possibilities open up when compliance becomes less of a chore and more of a strategic lever? It raises an important question, doesn't it? In today's world, with so much information, so many regulations, how can mastering specific detailed knowledge, like understanding Form 941 inside and out, not only ensure you stay compliant, but actually become a competitive advantage, allowing for smarter, more strategic allocation of your resources, rather than just reacting to deadlines and obligations?
Something to definitely think about. We hope this deep dive has given you a fresh perspective and, more importantly, some valuable, actionable insights. Until next time, keep learning, keep questioning, and keep diving deep into the knowledge that empowers you.